Well, I think the most important thing for investors to keep in mind right now is to not make portfolio decisions in moments of political or policy uncertainty, and instead really remain focused and very close to data. So with regard to interest rates going lower, clearly a great time to be looking at refinancing and taking care of the other side of your balance sheet. Clearly not a good thing for savers who are holding cash.
Right.
Probably at rates and at levels that would not benefit their portfolio.
But are you telling people who have that bond exposure, be careful? You know, these prices are looking too high now, these yields are looking too low, or do you feel comfortable with what you're seeing?
Well, I think I feel comfortable with what we're seeing only because when you're looking at portfolio rebalancing, you really want to take into account that if you have unusual moves in any one of your asset classes, you should be taking gains and adding to areas of your portfolio that are underperforming. The one thing I just would quickly note on that is that you really have to take a look at what kind of dividend rates that we're getting now in the stock market, again, relative to a 10-year bond. And if you're willing to hold a bond for 10 years at 1.6, 1.7, why wouldn't you own the market when we have annualized returns between 8 and 10?
Yeah, and a dividend yield.
And yields above, higher than that, higher than 2.
Jason, what about you? I mean, does the current environment scream to you, hey, something's out of whack and I got to lean against this? Or like so many strategists we've been talking to, do you say, I'm going to ride this, meaning, you know, yields are going lower and I'm piling in and as far as it goes?
So we actually went through the process of putting together a recession model last year, and the yield curve got its part in that, about 1/8 of that mix. So we have a pretty good way of kind of thinking through the recession implications here. And if you were to look at the yield curve alone, yes, it actually says effectively a 60% chance of recession. But the rest of the indicators, all 7 other of the 8 in our mix, are effectively saying very minimal risk. You know, a great example of that is high yield bonds, where spreads haven't really backed up that much. High yield is kind of a territory where investors are picking up pennies in front of the steamroller. So they're very aware of that steamroller that's approaching. And they're basically saying, this isn't a major concern for us. So, you know, our perspective with clients has been, look, we are in the 10th, 11th year of the economic expansion and bull market. It is getting long in the tooth. But at the same time, we're not seeing the buildup of it in excesses. And what we're recommending investors do is stick it out with your kind of neutral, full equity allocation. Build in a little defensive within that equity allocation in order to absorb the bumps, because we are late stage and we do have things like trade policy that's going on causing some of these bumps. It feels good to have a little bit of insulation from that, but don't take that too far yet, because this expansion sure still looks alive and well, even though it feels like it's really bumpy sometimes.
Dan, let's get your thoughts in here. You know, typically when interest rates decline or when the Federal Reserve goes into a quantitative easing program, as they did for years and years there earlier this decade, risk assets do well. It drives money out of safe assets, ultimately to seek higher returns. But you say that's unlikely to happen this time. Why?
Well, think about the last 2 times, Tyler, that we've had rate cutting cycles over the last 20 years. Back in 2000, the 10-year Treasury yield was above 6%. It went all the way down to 1%. That was not good for equities on the way down to 1%, because the S&P 500 got cut in half between the highs in 2000 and the lows in 2003. Then you think back to the highs in the stock market back in 2007, when it made a new high, that the 10-year Treasury was above 5%. Fed funds went to 0, okay? What happened to the S&P 500? It got cut in half. So all these prior guests that I've been listening to all day long talking about how, Tina, there is no alternative, rates are going lower, we're just looking at all this sovereign debt at a race to the bottom. This is not good for risk assets, specifically equities, right now. So the way I think about it is we are embarking on a rate cutting cycle when Fed funds was at 2.25. No one knows how this thing is going to play out. The S&P is 5% off its highs. Every single time since the high in 2018 in January, when the S&P has made a new incremental high, what have we done? We've flushed lower. We had a 12% decline. Then we had a 20% decline in Q4 2018. We had a 7% one in May, and now we're in a 5% one. Do not buy highs in this market. There is no torque to get a meaningful breakout right here. And I think equity investors have done well to buy the sell-offs, but buy into fear, not buying euphoria when we make that new incremental high.